Hey there, welcome back to our channel. Today, we're going to be discussing a topic that is crucial for all investors, the 7 immutable laws of investing. These laws were presented by financial commentator and strategist James Montier, and they provide a framework for making sensible investment decisions. Let's start with the first law. Always insist on a margin of safety. The first law states that we should always insist on a margin of safety when making investment decisions. The margin of safety is a concept that was popularized by Benjamin Graham, who is widely considered the father of value investing. It refers to the difference between the intrinsic value of an asset and its current market price. The idea behind the margin of safety is that by buying an asset at a significant discount to its intrinsic value, an investor can protect themselves from potential market fluctuations or unforeseen events that may negatively impact the value of the asset. This means that even if the asset's value does not perform as well as expected, the investor will still be able to sell it for a profit. There are various methods for calculating intrinsic value, such as discounted cash flow analysis, price-to-earnings ratio, or price-to-book ratio. One of the most widely used method is discounted cash flow analysis, DCF, which involves estimating the future cash flows generated by an asset, and then discounting them back to their present value using a discount rate. It's important to note that simply buying companies that are trading at a huge discount is not the only approach to follow. An investor should not only look at discounted prices but also take into account other factors such as the company's financial health, management, industry trends, and competition, as well as future growth prospects, before making an investment decision. This time is never different. This law reminds us that market cycles repeat themselves and that we should avoid being swayed by market trends or hype. Montier emphasizes that this time is never different and that we should be aware of historical patterns in the market to guide our investment decisions. By focusing on the long-term value of the companies, rather than short-term market fluctuations, investors can make more informed investment decisions. One of the main benefits of this approach is that it allows investors to avoid the trap of chasing hot stocks or sectors that may be overpriced. It also helps investors to identify true opportunities rather than being swayed by market noise and emotions. Additionally, it enables investors to hold on to investments through difficult market conditions as they are more likely to have a solid underlying value. Be patient and wait for the fat pitch. The third law encourages us to be patient and wait for the right opportunity to make investments, rather than rushing in. Montier argues that this approach will increase our chances of success and protect us from impulsive decisions. This approach can help investors in several ways. By being patient, investors can avoid making impulsive or emotional decisions that may lead to poor investment outcomes. By waiting for the fat pitch, investors can increase the chances of finding undervalued or overlooked opportunities that have the potential for high returns. By focusing on the long-term potential of an investment, rather than short-term market fluctuations, investors can reduce the chances of being negatively impacted by market volatility. Additionally, by being patient and waiting for the right opportunity, investors can avoid the pressure of trying to time the market, which can be a challenging task even for professional investors. Be contrarian. The fourth law suggests taking a contrarian approach, going against the crowd rather than following it. Montier argues that by going against popular opinion, we can capitalize on market inefficiencies and potentially make higher returns. This approach can help the investor in several ways. By going against the crowd, investors can potentially find undervalued assets that have the potential for high returns. When the market is optimistic about a particular asset or sector, prices tend to rise to levels that may not be justified by the underlying fundamentals, creating a buying opportunity for contrarian investors. By avoiding popular assets or sectors, investors can reduce the chances of buying into a market bubble, where prices are artificially inflated and are likely to come crashing down. By being contrarian, investors can also benefit from the psychological biases that affect market participants, such as herding behavior and overconfidence, which can lead to overvaluation or undervaluation of assets. However, it's important to note that being contrarian is not always the best approach, as sometimes the market has a good reason for being optimistic or pessimistic about a particular asset or sector. Therefore, before taking a contrarian stance, it's important to carefully evaluate the fundamentals and future prospects of the asset or sector in question. Risk is the permanent loss of capital, never a number. The fifth law emphasizes that risk is a multifaceted concept and it is foolhardy to try to reduce it to a single figure. According to Montier, risk is defined as the possibility of losing some or all of an investment. Permanent impairment of capital means that the loss is not recoverable and cannot be regained. This is why risk is considered a permanent impairment of capital, because once the capital is lost, it cannot be regained. There are different types of risks that investors may encounter, such as valuation risk, fundamental risk, and financing risk. Valuation risk refers to the risk that an asset's intrinsic value is not accurately reflected in its current market price. This can occur when an asset is overvalued or undervalued, and can lead to potential losses for investors. Valuation risk can be caused by a variety of factors, such as inaccurate financial statements, changes in market conditions, or a lack of information about the asset. Fundamental risk refers to the risk that an investment will not perform as well as expected due to underlying business or economic conditions. This can be caused by factors such as changes in management, changes in industry conditions, or changes in government regulations. Financing risk refers to the risk that an investment will not perform as well as expected due to issues related to the financing of the investment. This can include factors such as changes in interest rates, changes in credit conditions, or changes in the availability of financing. Be leery of leverage. The sixth law warns us of the dangers of leverage, arguing that it can turn a good investment bad. Montier stresses the importance of understanding the potential risks of leverage and the ways in which it can limit our staying power and transform a temporary impairment into a permanent impairment of capital. Montier has pointed out that leverage can create a false sense of security, as investors may assume that they are protected from losses due to the use of leverage. However, in reality, leverage can amplify losses just as easily as it can amplify gains. He also argues that leverage can lead to overconfidence and impulsive decision-making, which can lead to poor investment outcomes. Furthermore, Montier has emphasized that leverage can be dangerous because it can lead to financial ruin, particularly during market downturns, as investors may not be able to meet margin calls and may be forced to liquidate their investments at a loss. Never invest in something you don't understand. The seventh and final law states that we should never invest in something we don't understand. Montier argues that if we can't see through the investment concept and get to the heart of the process, then we probably shouldn't be investing in it. The phrase "never invest in something you don't understand" is a reminder for investors to thoroughly research and understand an investment before putting money into it. It suggests that investors should avoid making investments in assets or sectors that they do not fully understand or cannot reasonably predict the performance of. This approach can help investors in several ways. By only investing in assets or sectors that they understand, investors can reduce the chances of making poor investment decisions. They will be able to identify the potential risks and rewards of the investment, which allows them to make more informed investment decisions. By understanding the underlying fundamentals of an investment, investors can better predict the future performance of an investment. This can help them to make better investment decisions and avoid the potential traps of investing in assets or sectors that they do not understand. By avoiding investments in assets or sectors that they do not understand, investors can reduce the chances of being negatively impacted by market volatility or unforeseen events. These 7 immutable laws of investing provide a useful framework for investors to guide their decisions and avoid common mistakes that can lead to the permanent impairment of capital. By following these principles, investors can increase their chances of success and protect themselves from errors and misfortunes. So, there you have it, the 7 immutable laws of investing. We hope you found this video helpful and informative. Remember, as always, it's important to do your own research and seek professional advice before making any investment decisions. If you like this video, don't forget to give it a thumbs up and subscribe to our channel for more investing insights.